You just bought an S&P 500 ETF, 500 companies, maximum diversification, safe and spread out. Except that's a lie, because right now, just 7 companies make up over a third of the entire S&P 500. And by the end of this video, you'll understand exactly why that's happening, why almost no beginner talks about it, and the one simple shift that actually fixes it. Let's start with what you think is happening when you buy an S&P 500 ETF. Most people picture this. Your money gets split evenly across 500 companies. Each one gets a little slice. If one crashes, no big deal. You've got 499 others holding you up. That's not how it works. At all. The S&P 500 is market cap weighted. And that phrase sounds boring, but it changes everything about your money. Here's what market cap weighted actually means. The biggest companies in the index get the biggest slice of your money. Automatically. You don't choose it. The index does it for you. So when you put $1,000 into an S&P 500 ETF, it doesn't go to 500 companies equally. Apple gets a massive chunk. Nvidia gets a massive chunk. The company ranked number 400, they get pennies. Out of every $1,000 you invest, roughly $340 goes to just 7 companies. The other 493 companies split what's left. Let that land for a second. So who are these 7 companies? Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla. Every single one of them is a technology company, which means your diversified S&P 500 ETF is secretly a tech fund. It just comes wearing a sheep costume. Now, here's what really matters. This wasn't always the case. Back in 2014, the top 7 companies made up only about 15% of the index. 15. Today, it's 34. That concentration has more than doubled in a decade. Why? Because these companies exploded in value. Nvidia alone went up something like 27,000%. Apple nearly tanked. Microsoft nearly tanked. Apple is now worth about $3.4 trillion. That's bigger than the bottom 200 companies in the S&P 500 combined. One company. Bigger than 200 companies. Put together. So is this actually a problem? That's the real question. And the honest answer is, it depends. Because concentration risk cuts both ways. When big tech is crushing it, your portfolio crushes it too. You've been benefiting from this concentration whether you knew it or not. But if these 7 companies hit a rough patch at the same time, your portfolio takes a much harder hit than most people expect. Because you're not diversified, you're concentrated, and most people don't even realize it. Now, here's something that might surprise you. This has happened before. In the early 1970s, investors piled into what they called the Nifty 50. 50 can't lose stocks that everyone thought would grow forever. Then the market crashed, and those concentrated holdings got destroyed. Then, in the late 1990s, it happened again. The dot-com bubble. Everyone piled into a handful of internet companies. The crash wiped out about $5 trillion in market value. Now, I'm not saying a crash is coming. The companies dominating today have real earnings, real cash flow, real customers. This is not Pets.com. Apple makes more profit in a single quarter than most companies make in a lifetime. But concentration creates fragility. Even great companies can have rough years. From 2000 to 2009, the S&P 500 had a negative return for an entire decade. People who kept buying every single month still came out fine eventually. But that's a long time to stay disciplined. So what do you actually do with this information? 3 options. Option 1. Do nothing. If you're young, you're investing for decades, and you believe in the long-term strength of American business, the S&P 500 has historically rewarded patience. The concentration is a risk, but it's not a guarantee of disaster. Option 2. Look into an equal weight version of the S&P 500. An equal weight fund gives every company the same allocation, regardless of size. Apple gets the same slice as the smallest company in the index. This means if big tech pulls back, your portfolio has more cushion because you're not so dependent on 7 companies. Some investors split their money between both approaches. That way, you capture the gains of market cap weighting but reduce the concentration risk. Option 3. Look beyond the S&P 500 entirely. The U.S. stock market is about 60% of the global stock market. But there's another 40% out there. Companies in Europe, Japan, emerging markets. Adding international exposure instantly dilutes the concentration problem. If U.S. tech takes a hit, your international holdings can soften the blow. And to be crystal clear, this is education, not financial advice. Your situation is your situation. But the principle applies to everyone. Understand what you actually own before you put another dollar in. Most people buying the S&P 500 have no idea they're making a concentrated tech bet. Now you do. That puts you ahead of most investors. If this was helpful, there's more on the channel. No pressure, just real investing knowledge broken down simply. Because the most expensive mistake in investing isn't picking the wrong stock. It's not understanding the stocks you already picked.